Yeah.
You went to all business.
Yes.
So now you can take the one of all.
That's right.
That's wonderful.
Had a great experience.
Yeah.
And like I said, I'm
Well, thank you everybody, and thank you to our excuse me. Thank you to our last panel. This has been an absolutely incredible day. As somebody that has, thought so carefully about these issues and researched them for so long, kind of by myself, it's really a lot of fun to have other people give me some feedback and get these different perspectives. And I think that throughout the course of the day, we really have had a whole variety of perspectives, and I really appreciate kind of the good humor and the collegiality that we've had all day, even when on substantive matters, I think there's some significant disagreement. So with the last, maybe just about 15 minutes here before Brad concludes for us, I thought, let me just make a couple of comments about what I've heard today, and then open it up for comments or questions from the audience, and I'll see what I can do to answer those of what you're still interested in learning more about. So just a couple of comments in response to what we've heard today from our panelists. I think, what maybe most overarching comment is there's been a lot of consistency, I think. I think a lot of the things that, one panelist said is backed up by another panelist and by theoretical ideas and by data and by experience. And so I think that we are kind of circling towards what's really going on out there and really what is effective. One question, kind of a suite of questions have been asked and raised about what are the financial returns in this field, and Abe was asking earlier in the day, are there super users, or who's investing in these sorts of things? And as we've said, I mean, when you have the New York Stock Exchange with active trading, you can figure out what companies are worth on any given day. But these sorts of companies, investment crowdfunding and private companies, are not traded on a daily basis. There's no secondary market. So it's incredibly difficult to figure out what returns you've generated over time. And it'll just take years and years to really get a sense of that. But I do think that it might be the case that investment crowdfunding, where does it play a role in the real financial planning of an individual? I think that really, as the industry gets a little bit more mature and we get, higher quality companies listing, I think that over time, this could be which kind of like the holy grail for investing, a non-correlated asset class, where you can invest in the stock market, you can invest in bonds, you can invest in foreign stocks or small stocks or value. And one of the main things as a theoretical matter people are trying to do is to invest in non-correlated assets. They don't want everything to go up at the same time or down at the same time. And I think that with the really long time that it takes to generate the returns in these sorts of businesses, and they're very different than public companies, I think that this might be actually useful as a financial matter, as a small component of a retirement plan, as a non-correlated asset. There was a point, Allison made the point that the lead investors who were saying, I invested this much and I'm really behind this, that these lead investors are not a fiduciary of the crowd that's maybe relying on them. And that's true. That is true. But I do think that the term reputation has been brought up a couple times today, and I talk a lot about it in the book. The online reputation, or the maybe global reputation of the lead investors putting their name out there and saying, this is something I really believe in. They're not a fiduciary, but there's a tremendous pressure to be honest and forthright in that, because if you're not, it could really come back to haunt you. And as we've seen, maybe to a greater degree than we wish we could, the internet never forgets, and can be very harsh on people who have said something that turns out to not be true, or something like that. So So with those comments, let me, if I can, if we still have the microphones out there, let me see if there are some questions, still remaining here at the end of the day that I can try to address and talk about some of the things that that are still interesting to you all. Please.
So I appreciate the comments on the investor side. Now, I'm with you. I'm a founder and CEO considering whether to do crowdfunding. And I'm here trying to, trying to evaluate what are the considerations that I need to take into account when decided to crowdfund. And what are the costs associated with crowdfunding? And trying to create these criteria for pros and cons, and not just in the vacuum of, I am just going to crowdfund, or I'm only going to go for VC, or only go for non-dilutive funding, right? But when creating my funding strategy, how do I incorporate crowdfunding into that? So if you can talk about it, or maybe Johnny can talk about it, or Sanjay can talk about it. And I think one of the things that I learned today that I hadn't really thought about was the tax consideration, right? How can we think about those things when we are putting together that strategy, that funding strategy? Yeah.
Well, okay, it's a good question. I think the costs are coming down every year as there's kind of an industry that's developing of the platforms that are getting better at guiding the entrepreneurs through things. There are specialized lawyers and consultants that are getting very good at efficiently filing the Form C that has to be filed and other items like that. And so I think that it's becoming increasingly efficient. But I also think, and Johnny said this, and I think you were hinting at this as well, that it's definitely not an either-or proposition. And that far and away, the most successful model that I've seen around the world is really cooperative between the VCs and angel investors on the one hand, and the crowdfunding on the other. And it really is just super synergistic in that the entrepreneur can get money from the venture capitalist and advice, can get money from the crowd and brand ambassadors and a marketing boost. And the VC also can kind of get a whole lot more capital from the crowd to a portfolio company that it wants to support. And the crowd can get the comfort that there's a VC that has looked carefully at this. And so really the most effective way going forward for all concerned, I think, is really, and this is really what's going on in the UK especially, is the VCs and the angels and the crowd are all working together and finding opportunities that they find interesting.
Can I add to, I think your question, if I interpreted that, it depends on the kind of business you're running and what your product is. If your product is sort of likely to appeal to many consumers out there and you're trying to sort of find out if they like what you have, whether it's a piece of art or some music or some consumer like, his whiskey thing, that's appropriate for crowdfunding. On the other hand, if you are writing or if you're developing, say, an inventory management software, that doesn't sound like a crowdfunding opportunity. I mean, how many people would maybe like a half a dozen people in the world of big companies might have an interest in that. So a lot of that, would depend on what is it that you're doing. And that's why crowdfunding you hear a lot about, because it mostly is a B2C, and it mostly attracts consumers or is directed towards it. Sorry.
Andrew, it sounds like you're saying the lawyers are probably in there somewhere.
Oh,
You
yeah.
probably have to hire a lawyer somewhere in there to get all this paperwork right.
You do, but they are getting their systems really in place, and that they're getting quite efficient at it. And let me just make one point on this last one. And Sanjay's definitely right. The type of company it is makes a huge difference. But it was a platform founder in Australia that really emphasized this for me. He said, but it's not only consumer products. There are a lot of, as long as there's a story and it's interesting and it's something that people might want to support. Like, for example, in Australia, there was this company called Cbin, BIN, and that's what they call like a rubbish bin. And so like it's this sort of device that goes out and like you put it out into near the beach, and it collects the rubbish that's been like kind of floating out there. That's not a consumer product, but that's the sort of thing that can capture the imagination and people would want to support.
First of all, thank you so much for being here. This has been a fantastic conversation. I've learned a lot. My question is, there's been an ongoing narrative about crowdfunding being or helping circumvent a lot of innovation outside the traditional innovation centers such as San Francisco. And I was wondering, from your perspective, what is the next step that crowdfunding needs to take in order to help stand up these competing centers of innovation across the country?
It's an excellent question. I think that, and we're trying to ameliorate it right here. I think that the number one issue is just people don't know about it. Entrepreneurs haven't heard about this. Investors don't know about it. More have learned each year. But I think that as investors, or as regular people that I talk to, I discuss this with them. A lot of people say, "Wow, that's really interesting. I'm very interested," like Todd. And entrepreneurs likewise. There are a lot of entrepreneurs who would like at least the option of including their customers or in their journey and that sort of thing, and also having more ability to kind of name their own valuation and other terms, as opposed to being negotiated down to nothingness by some, experienced VC.
Jocelyn, there's a hand behind you.
May I? One thought that I had about what Professor Zwicky's comment was I think that maybe the market can be segmented between people who are trying to make money or people who are trying to have a sense of agency. And, perhaps a panel like this should include some people who understand the dynamics of crowds and social psychology, because I think there are a lot of trends in the culture, including the transfer of wealth between generations, that probably has a lot of bearing on, what course things could take.
Good point. Well, let me say, and I think Abe said this, and Todd was hinting at it as well, and maybe some others, that if a person enjoys it and gets value from it, then that's worth something unto itself. And the agency of being able to, send a text message to the founder of the company that you just invested in, and they write right back to you. People like that. That's valuable in and of itself. But I do think that in the end, there is a financial motivation here, and that it is not just charity and is not just supporting a cause. That's a part of it. But I think, and this is, Johnny years ago worked at Kiva, and Kiva is a sort of organization where, let me just say it most simply, like people lend money to businesses for 0% return. I think that can get you somewhere, but I think that you get so much more money and so much more capital flow if there's even a chance, a promise of some financial return. But let's just get to one or two more questions, and then I'll turn things over to our MC, Brad Bernthal.
Awesome. Thank you all for being here. This is fascinating. I'm learning so much today. First, just a quick PSA. If you don't know what a safe is or how it works, Carta has really awesome videos, and I encourage you to watch, especially their Cap Table 101 series. Question, how are people managing the cap table to make sure there aren't hundreds of people with tiny slivers of the company?
That's a softball. It's a great question. Because it used to be a huge issue that when the statute and Reg CF was initially put in place, if a company raised money and sold shares to 1,000 investors, it now had 1,000 shareholders on its cap table, And a next round VC might say, I don't want to be the 1,001st investor. No, thank you. So that was a huge issue that would deter companies from even trying this in the first place. Looking to other areas of law and what other countries have done, in 2020, the SEC changed the regulations to allow special purpose vehicles, SPVs, which means that instead of there being 1,000 people on the cap table, there's just one, the SPV, and then the SPV has 1,000 shareholders. And that was, is my understanding from the industry, absolutely vital, and it's really solved a big problem there. All right, last question of the day, my friend, thank you.
You guys have talked very much about getting investors in, nothing about getting them out. And Allison is very well aware all of the previous investment things required liquidity for the investor downstream. Is Johnny going to come out with an exit system that allows that investor to recover money on an illiquid investment?
There are the beginnings of secondary trading here and in other countries too. It's sometimes done like 1 week per quarter, so that you get all the traders there for one time. It's not the New York Stock Exchange. There's just not enough shares out there at one time. And just one other point on an exit. There's certainly anecdotal stories of companies being bought or going public and other things, but also because, at least in the US, the securities that are being offered can be of any type. Sometimes the company will include a term that says something like, and these shares can be repurchased by the company at a fair price or something. And that happened, for example, with Meow Wolf, this like art exhibit. The company raised $1 million or $2 million, maybe more, through investment crowdfunding. But one of the terms said these can be repurchased, and they were. The shares were sold for maybe $20 and were repurchased a year or two later for $80. Some people thought that was great. Some people thought some of the shareholders were really upset. They didn't want to be bought out. But so with that, let me please turn it over to Brad to conclude us for the day. Thank you.
All right, so there's a line which is often associated with faculty meetings that everything has been said, but I haven't had a chance yet to say it. I'll try to avoid that here. First is, boy, this was an intellectually nourishing day. I've got at least 6 pages that suggest that I learned a ton myself. I hope that many of you did, which is really gets to the essence of, I think, public university interacting with the community and convening a group that is really, really cool to be a part of. I encourage you to come see us again at Silicon Flatiron soon. On Tuesday night, we've got the Startup Variety Show here in the courtroom, and then looking out to October 6th, I mentioned before, is our next conference, which will be about generative AI and copyright. That should be really terrific. I know what many of you are thinking right now, which is, how could I support Silicon Flatirons? Johnny, let's talk. If you'd like to, I'd be happy to. In terms of substance, this has been such a great discussion. I just wanted to say we've had some founders who have been here who are thinking about crowdfunding, including, I know that Invisible Inc., rather than me distilling any of the substance, is there a question that's pending yet that we could get out on the table? You're like, this is pressing. Before I leave, I want to know this. And I'll give the prerogative to our friend from New York first.
Yeah, if you don't have fairly revolutionary. Investors and
Johnny, you want to take the first swing at that?
Yeah, so our general, this is hopefully one thing me and Alison can agree on. Our general perspective of WeFunder is, if WeFunder didn't exist, what would you do? So if WeFunder didn't exist, what valuation would you be raising on? And I would say, would you do a SAFE or a convertible note or a price round, or would you do a revenue-based financing deal? And if WeFunded didn't exist and you were raising from sophisticated, accredited institutional investors, would they invest in a subsidiary? And if not, then we don't like kind of doing things differently because it's unaccredited investors, because it's Reg CF. So usually I kind of pass the buck and I say, I don't know your business, I don't know your industry, I'm not investing. The only person whose opinion counts on valuation and terms is someone writing a check. So who's going to write the anchor checks into your WeFund campaign? Or have you already raised from larger investors? And what terms are they investing in? And kind of start there, and then take those terms and put that up on WeFund. That's kind of our paradigm.
All right, a couple thank yous as we conclude the day. First, thanks again to all of our out-of-town guests and speakers. In addition to our moderators, Mark and Rabia, super skillfully done. It was really terrific. Also to the Tech Journal for being a fantastic partner and pulling together a really intellectually rich day. Silicon Flatirons, our team, including two people that I was remiss not to identify. One is Matthew here, who's our newest team member. Talked to him about space law, and not a fully fledged member of the team in terms of our payroll, but Lisa here, you'll see some terrific photos coming out of this. And by the way, if you want to see some fantastic rock and roll photos, talk to Lisa about her collection as well. She did a show this summer that was really a treat. And finally, and I think most appropriately to end with this note, please join me in a hearty congratulations to Professor Schwartz on a terrific book, and thank you for sparking really a terrific day for us here. Andrew Schwartz.